Good morning, market scholars, and welcome to your dividend growth investing class for Tuesday, December 3rd, 2019. I'm your host, Brandon Banzi. Before we kick things off here, can we get a quick sound check? Are you guys hearing my voice coming through okay? I'm asking because yesterday my power went out. Some of you might have noticed that if you were in my options class yesterday. Okay, thank you. I noticed that the last time the power went out, I had sound issues the next time I fired up WebEx, so I just wanted to make sure we were good to go here, so thank you for that. A little bit of a pullback in the markets here today, kind of a two-day pullback all of a sudden, and probably long overdue. If you guys have been watching David and I's market outlook videos over the last couple of months, you'll know that we had gone on a very extended near-term run, which lasted like 30 days, and it typically is about half that. And so usually if the bullish run is too much to the upside, like we saw during that time period, when we are overdue for a pullback, it stings a little bit more. It's going to have to give back a little bit more as well, and that perhaps is what we are experiencing right now. Obviously, the trends are still bullish, and markets are still closer to all-time highs than to yearly lows or anything like that, so we don't want to make too much of it, but maybe this is an opportunity for us to go out there and hunt for value. And of course, in this particular class, that's exactly what we set forth to do. So we'll see if we can uncover that here today as we move forward. All right, let's go ahead and take a peek here at our disclosures. Reminder that everything that we discuss is for educational purposes only. We're not your licensed financial advisors or broker-dealers. Keep in mind that the trading of securities can involve high risk and the loss of any funds invested. Now remember, we have brand new students in our class here today that are basically joining us for the very first time. So if you guys could give them all a warm welcome and let them know what a great experience you've had with Market Scholars so far. Hopefully that'll go a long way into helping them ease into their transition into becoming a student with us here. So I do appreciate those of you that are welcoming them into open arms. But if you are new, which we had a number of people join us over the weekend with our Black Friday sale, one thing I need to stress to you is that this is not a financial advisory service. We are an education service. There is a difference there. We can't be an advisory service because we're not licensed in the financial industry. And so we can never tell you what you should or should not do. And if you ever get that sense that that is what is taking place, make sure you take a step back, take a deep breath, and remind yourself, hey, we're just sharing ideas here. We're more than happy to share our experience and our thoughts. David and I have both been investing ourselves for 2 decades, and so we've got a lot of things to hopefully impart upon you, but we don't know the future any more than you do. And so if you ever do take any trades based off of things you're learning in our classes, remember that those decisions are yours and yours alone, so you do bear that personal responsibility there. If you have any questions on any of this, make sure you seek out our terms of service on our website for additional information. I do appreciate those nice, lovely chats coming through there as well. You guys are great. All right, today's agenda, as always, we're going to be looking at a dividend growth investing mentality. Now, that's a different mentality than you're going to find in almost any other trading room. So if this happens to be the first class you've attended at Market Scholars, if you're one of those new students, be aware that this class may not be for you. So I've got to kind of stress that because this is a different type of class. I ask you to become a business owner in this class, not a stock trader. And that may not be what you're used to. So be aware that we do have a wide variety of classes at Market Scholars that run from anything from swing trading and active trading all the way to this class, which would be considered the closest to kind of long-term buy and hold type of investing. So if this isn't your cup of tea, no worries there. We'll have plenty of other classes that could kind of become a little bit more useful for you. But if you are somebody that is looking to enter into the stock market, take reasonable risk for an opportunity for reasonable reward, then perhaps this is a class that could be useful for you. Now, in this particular class, we're going to look at 2 different dividend growth investing stocks from a variety of angles. And so we will look at things like business models in this class and try to get a sense of, you know, what is the current situation with the company and, you know, what sort of opportunities, what sort of obstacles they may have. I'm getting some chats there from Ken saying that there's no sound. Can we just get a recognition in the audience that there is sound. I already did a sound check, so I know it's working. But for Ken, he can't hear me right now. So if you guys could just chat in real quick and let him know that there is sound and he might need to log out and log back in, that would be great. Thank you. All right. And then after we go through that analysis of those two different dividend growth investing stocks, let's vote to possibly put one into our class portfolio. Now remember, if you guys don't like either of the choices I have, voting for none of the above is perfectly acceptable. There's nothing wrong with that at all. There's a time and a place for all types of companies, and this may not be the time or the place for the two companies we look at here today. So I do want to stress that. That's an opportunity that you do have, and we would have that flexibility if I look at the calendar and how many stocks we have currently and how many stocks we need to have by the end of the year. It would give us an opportunity if you wanted to vote for none of the above. That wouldn't be a problem with the way things are structured here currently. That is a reminder as well to those of you that might be new. What we do in this class, because it's meant to be a buy and hold class, is we will look for building a 6-month portfolio. Now, the idea behind that is to construct a long-term portfolio that you plan to buy and hold, but construct that over a 6-month window. And we kind of take, the semesters approach, if it were, the first half of the year and the second half of the year. So this is the second half of the year portfolio. And the reason I'm stressing that right now is if you are new, you'll have to recognize that as we get into the end of the time period of these portfolio building processes, my choices as the educator to bring your way are going to be worse. So I can't say for sure whether the stocks we look at today will go up or down in the future. I can never say that. But what I can tell you just from my own perspective is that I generally view the trades that we have at the beginning of the 6-month portfolio as better, all else being equal, than the trades we have at the end of the 6-month period. When we build out a 25 stock portfolio like we do, and we start with a 100% portfolio of cash like we did on July 1st, the world is our oyster. We can pick from any given number of stocks out there. So we have lots and lots of choices. As that 6-month period goes on, like we're in now, in the final month of this 6-month period, my choices have already dried up because we've already looked at most of the best opportunities from a dividend growth investing perspective. And so we're kind of left with, what else is there, kind of scraping the bottom of the barrel, as it were. Now, that won't always be the case. Keep in mind that if there's ever a 6-month period where we start with a really elevated and expensive stock market at the beginning of the 6-month period, and that stock market goes lower and lower and lower throughout that 6-month period, during those time periods, you might find that we will indeed have better opportunities at the end. But more often than not, especially what we've experienced in the last 11 years in this bull market that we've had, naturally stocks rise. And if stocks are rising during the vast majority of 6-month periods, and that typically means that our better choices are at the beginning of the portfolio. So I'm bringing all this up because of the unique situation here with Black Friday being close to the end of a 6-month period. If you are a brand new student here today, it might be wise for you just to watch the first couple of sessions here during the month of December. And then once January hits, we're going to start this process all over again with a brand new portfolio. And it's at that time where you might be able to find some better choices for your own portfolio. So I'll just put that out there as food for thought. Again, I can't tell you what you should or should not do with your own money, but I'm just going to give you that as kind of one little bit of experience that I've had over time with teaching this style of investing. So take it for what it's worth. All right, so note there in the orange, this is a time-constrained, coach-driven presentation, so I'm not going to be able to answer your guys' questions here on the fly. However, I'd be happy to answer your questions on Thursday during the Q&A session. 11 a.m. Eastern time is when I teach mine, where I'd be happy to kind of have a little bit more flexibility there in time to kind of give you, a 10 or 15-minute answer to your question. Of course, I wouldn't be able to do that in this class if I want to get it done in an hour's worth of time, which is what we strive to do as our goal for these trading rooms. So with that out of the way, let's go ahead and move forward here and kind of get a framework for what we're hoping to accomplish here today, which is basically getting an understanding of how we should approach the market. And so anyway, think about, the idea of dividend growth investing as being a way for you to approach long-term investing as a way to kind of look for income in addition to looking for capital appreciation. But we kind of start with the income component because it allows our idea of filtering for quality to kind of shine through with looking for proper investments. Give me just a second here. I've got something kind of weird going on the side. Okay, I think I'm good. All right. So with dividend growth investing, we look for companies that have long histories of dividend increases. What that helps us do is filter for quality. With the general idea of, let's just take Coca-Cola as an example. Coca-Cola is on my mind because I saw some chats here on Twitter recently talking about how Buffett has basically a 50% yield on cost on Coca-Cola, which is something I've shared with you guys for many years now, but is a fascinating concept, especially to somebody that's newer to the idea of dividend investing. Remember, dividend investing is oftentimes kind of posed as a search for yield or a hunt for yield. Now, what people don't typically tell you is that your yield changes. Your personal yield changes. Your yield is not locked in at whatever price you buy that stock at in the beginning. Assuming that the stock continues to raise its dividends over time, your yield on cost will rise over time as well. And that's a fascinating concept because, like in the case of Buffett with Coca-Cola, every 2 years that he continues to hold that stock, it basically pays him back enough in dividends to pay off his entire investment that he made back in the late 1980s with that investment. Now, that takes, of course, a very excellent company, but it's not unheard of. I will tell you that I've worked with students in the past that have had more than a 100% yield on cost on a stock like Altria, if you were to include all the spun off pieces of it. So it's not impossible. It's not likely at the same time. What you need is an exceptional company and a long period of time to hold it. But it does remind you that, if Buffett bought Coca-Cola when it was yielding 2% back in the late 1980s, today his personal yield on it is 50%. That's an eye-opening concept for a lot of people that they didn't realize that in the past, because they're typically just used to kind of dealing with the percentages of whatever their bank account returns, in their savings account or what have you. So that's kind of an interesting concept that can really help you stay the course in terms of investing. Now, these companies like a Coca-Cola that have long histories of increasing those dividends, I'll tell you that they are, generally speaking, considered to be very impressive companies that oftentimes have mundane business models, considered boring by some, but they are oftentimes in areas that are not prone to disruption. So that's kind of what we look for here. You'll oftentimes hear me say that our battle cry in this class is buy high quality merchandise on the cheap. So there's two different kind of angles to that concept. There's buying high quality merchandise, and then there's figuring out what is cheap. So a lot of what we do is try to determine what is high quality merchandise by evaluating fundamental metrics, including how many years in a row does the company increase its dividend. Back to Coca-Cola, it's got 50 years plus of increases of dividends. In that particular case, you can imagine all of the things the world has seen in the last 50 years. Just in recent history, we've seen, of course, the great crisis of 2008 and 2009, along with the dot-com bubble. But you go back, through the inflation scares of the 70s, et cetera, when you're looking at Coca-Cola's dividend increase streak. So they've been proven as an organization, as a business, as an operating business, to be able to shell out more and more money to their shareholders every year, regardless of what's happening around them. It takes a very high-quality company to do that. You couldn't do that by accident. Let's put it that way. You couldn't just accidentally wake up one day and have more than 50 years in a row of dividend increases. So you have to set forth. And the interesting thing about that is today's board of directors that's making the decision at Coca-Cola to increase the dividend every single February, in the middle of February, is not the same board of directors that was there 10 years ago or 20 years ago or 40 or 50 years ago. So it's a culture issue just as much as anything else, where they respect the shareholder and the owner of the business enough, aka us, the shareholders, to award us a higher amount of money each consecutive year. So, all of that kind of wrapped together is saying we are looking for high quality companies. We are looking for them to pull back during a momentary time where their yields become attractive, where we try to take advantage of that by buying them at those attractive prices, and then set down that course of having that yield on cost go higher as time goes on. We don't use stop losses or target prices in this class, so just be aware of that. Again, that's not my suggestion to you. I'm just telling you that that's not what we do in this class. We do use stop losses and target prices in some of our other classes, but not in this one. This is meant to be a business owner mindset here. And if you're using stop losses and target prices, oftentimes you're letting the market decide when you sell your business. And of course, that's not what you typically want. If you're a business owner, you want to be the one that decides when you sell your business, not let somebody else decide that for you. And then oftentimes we'll use drips to compound returns further as dividend growth investors. Now, depending upon who you are, there's different goals here for different people. Income is one of the key goals, which is dividend growth investing can be an excellent income generator to help pay for expenses during retirement, right? Many of you are retired, but you might already have a Social Security check or a pension check or something along those lines, but you're just finding it's not enough to kind of finance your lifestyle or allow you to take that extra trip to see the grandkids or what have you. So dividend growth investing is a way for you to kind of, get a little bit of an income injection, right? There are obviously excellent companies out there like Alphabet and Facebook and Netflix that don't pay dividends, but they're not going to allow you to kick a little bit more income into your, cash flow personally. Unlike bonds, dividend growth investing also helps you offset inflation. Remember, bonds are called fixed income for a reason. Those fixed income investments can be useful because they tend to be more stable than stocks, but what they don't do is they don't raise your income as time goes on, and that is one of the appealing elements of dividend growth investing. And then total returns are also quite interesting for some folks, and that's kind of what drives my focus personally as a dividend growth investor. That's another thing I should mention, right? I teach 4 different trading rooms here at Market Scholars, but this is the one that I personally do the most of in my own investing. I really enjoy dividend growth investing. So for me, I don't need the income right now. I don't really need the inflation offset all that much either. What I do need is total returns. I wouldn't be doing this if I thought that the total returns were going to be lousy going forward as I approach retirement in a couple of decades. But history has suggested that a list like the S&P 500 Dividend Aristocrat list is a market-beating list. It beats the S&P 500 itself, and that comes directly from Standard & Poor's, the owner of both the Aristocrat list and the S&P 500. So they have both horses in the race, so to speak. They don't care which one beats the other. They'll tell you flat out the Aristocrats beat the S&P 500 over longer periods of time. So I think there's this general philosophy out there that if you're going to be relegated to only dividend stocks, like that somehow it's only utilities and REITs that you're going to be relegated to, that's not the case. You can have some exceptional winners. In fact, I was having an interesting Twitter back and forth with Dan Russo here over the weekend. Some of you might have seen that, talking about the various companies that were quote-unquote dividend stocks. And he was saying, I don't know anybody that owns Microsoft for its dividend. And I said, well, you can scratch that off your list because now you do, right? We bought Microsoft a handful of years ago when it was yielding 3%, and it has tripled for us over that time period and has continued to raise its dividends over that time period as well. And while its yield today is pretty pathetic, it's pathetic for a good reason. It's because the stock has skyrocketed, and those of us that took advantage of Microsoft when it was yielding 3% couldn't be happier. So, keep that in the back of your mind. Dividend investing encompasses all sectors. It's not just utilities. And so there are excellent opportunities out there to grow your nest egg from both an income perspective and a total return perspective. Now, in this particular slide here, I don't I don't go through all the line items here, so feel free to take a screenshot if you're new. But we usually just grab one of the line items each week and then add a couple of talking points to it. So let's go ahead and do the third line item in this case. On the pro side of the equation, straightforward structure and investing rules. That's one of the most appealing elements to it for me personally, because I am somebody that believes in long-term investing. I even believe in long-term investing on non-dividend stocks, if you can believe it or not. It's just the problem with what I've tried to do in the past personally with long-term investing in non-dividend paying stocks is I never know when to get out, right? With the dividend growth investing approach, I want to hold the stocks forever, just like I do with non-dividend stocks. The problem is with non-dividend stocks, you don't have a kind of a signal from the board of directors as to when to exit because this company is structurally challenged from a permanent perspective. It's not just a temporary thing that's setting the stock down. With a dividend stock, you do. When a company cuts its dividend, it's oftentimes signaling that that company is under significant stress. Many companies that have ultimately gone bankrupt have cut their dividend prior to doing so. Now, the good news is they don't do it immediately before that. Usually it's a prolonged process, but it is at least one way to get a direct insight from the board of directors, which we don't hear from a lot. Remember, board of directors, they kind of do their own thing and you don't hear from them a whole lot. You'll hear from the company through press releases, but you don't hear from the board of directors. One area where the board of directors leaves their stamp on a company is through the dividend policy. And if the board of directors deems it necessary to cut the dividend, it's oftentimes a sign that that company is structurally challenged from a permanent perspective, and it may be best to kind of exit stage left and go use that money of yours in more efficient ways. Let's put it that way. So I do like that straightforward structure of long-term investing. On the con side of the equation, dividends, even through drips, are taxable. So I like to remind folks of that every so often because as a financial educator, as I've been for the last decade, I can tell you that there are people that get confused around that point. Sometimes people turn on the drip in their account and they assume that because they are building fractional shares along the way that somehow they don't have to be taxed on that. Now, if you're doing that in a retirement account, that's a different story. There you probably won't be taxed. But if you're just opening a normal brokerage account, what's happening behind the scenes is the companies that you're purchasing pay dividends in cash. That cash dividend is then taken by your broker and then reinvested in fractional shares of that exact same company every quarter. So it's the payment of cash first that is the reason why those dividends still are taxable, regardless of what you do with it. So it's, whether you use the cash to go and, buy a trip to Australia or something along those lines, or whether you reinvest it in the same shares, the cash is still paid up front, and therefore it is still taxable if you're doing this style of investing in a taxable account. So just be aware of that. All right, so let's go ahead and now share the desktop here, and I'm going to go ahead and get my other monitor all established, and then we'll be off and running. Okay. So let's go ahead and first off have a conversation about where things stand. As I mentioned before, we're close to the end of this period here of the 6 months. Notice right here that we have over 20 stocks. We only have a few more to add to our portfolio. We do have one open order with Procter & Gamble, but it's likely not going to be a situation where we're going to get filled on that. And I told you that from the get-go, basically. At the beginning of July, Procter & Gamble was a long ways away from having a 3% yield. So we put it out there with the possibility of us getting filled along the way. And by the way, I can say that we were fortunate enough to get filled on Johnson & Johnson under the exact same philosophy. Remember, Johnson & Johnson and Procter & Gamble were both put in as open buy orders in July in the off chance that they would sell off enough to offer up a 3% yield. Johnson & Johnson did, and that was a $800 decision that we made there. Procter & Gamble didn't, but it didn't cost us any money, right? It just is basically earmarked some of our buying power in order to accomplish that. Well, it's likely not going to happen, and that's okay. It's no sweat off of our back. Remember, the broker doesn't charge you money for commissions at all these days, let alone, putting a buy limit order out there and then canceling it after the fact. So we'll end up canceling that in all likelihood next week to free up that buying power. But this is how things set right here under the dividend growth investments heading. These are all of our stocks that we currently own. And so if you are newer and this is your first week in class, then you're welcome to take a screenshot of that or whatever if you want to kind of get a sense of what types of companies our students have selected since July. And we have a wide variety of stocks, as you can see there. In fact, we do have exposure to all 11 of our sectors at this point. Some of them are doing quite well, like TD Ameritrade is up, 43% there for us. But we have our fair share of losers as well. I've noticed that Cisco's really fallen apart here this week with the rest of the technology space. So we're down 9% on our Cisco investment. So it does work both ways. On the whole, we have more winning trades than losing trades. But we do, of course, keep in the back of our mind that this is meant to be a long-term portfolio. So we try not to obsess too much over short-term returns, because if we do, it tends to lead to knee-jerk emotional reactions, which is the opposite of what we want to accomplish with a rational approach to long-term investing. So it is what it is. Obviously, we go to battle every week trying to make good decisions with our money for the long term, and I'd say we've done a pretty good job of that since July. So point is, we have a widely diversified portfolio here, and as we're at the end of this portfolio building process, we're now just kind of filling in additional pieces along the way. Today is going to be a little bit different than normal for those of you that have attended this class over time, because of some technology issues that I am having with Value Line. Many of you know that the research we tend to use in this particular class is Value Line tear sheets that I get through my local library. I'm not sure if you guys can confirm this on your own end, because I know many of you use Value Line as well. But this is what I get when I pull up Value Line here today, and I did try it on multiple browsers. Sometimes if you're having internet issues on various websites, you could pull it up on Edge or Internet Explorer or Firefox or Chrome, and one of them will work. Well, I did try this on multiple browsers, and this is what I'm getting this morning. So I don't know if this is an issue just with the Salt Lake City library, or if this is a library-wide system, because Value Line usually hooks into multiple library systems throughout the country. So I've noticed in the past, whenever we've had issues with it, it tends to affect everybody across the country. So I don't know if that's the case there as well. Thanks for the confirmation there, Greg. He's saying he's having that too, and that was my suspicion. So they're undergoing some maintenance, and that always kind of shakes things up for me, because I am a creature of habit, and so once I see that, I'm like, oh, now what? Because of course you don't like to see that on a Tuesday morning when we're going to use that information in class. So what we'll do this morning is a little bit different. We won't use Value Line like we typically do. We'll pivot over to a Morningstar approach of analysis. Now remember, for those of you that are new, my two long-term classes, I teach an Options for Long-Term Investors classes on Monday afternoon, and I teach this Dividend Growth Investing class here on Tuesday morning. They're both trying to build a long-term portfolio. They just go through that process a slightly different way. My Monday afternoon class sells puts and does buy rights in order to establish a long-term portfolio. This class does not use options at all. We use stocks exclusively. But the reason I'm bringing this up is to remind you that typically in my Monday afternoon class, we will kind of lean upon Morningstar as our research analysis of choice. And then in this class, we typically lean upon Value Line instead. And that kind of shakes things up, even for those of you that attend both classes. And there will be occasional times where we will look at the same stock in any given, 6-month period. And that kind of gives you the opportunity to say, okay, well, what does Morningstar's analyst say about it versus what does Value Line's analyst say about it? But I get both of them for free through my local library system, and many of you do as well. I happen to like both of them, and I've used both of them for decades. In fact, Value Line I've been using for nearly 2 decades at this point. I like both of them because they're not traditional Wall Street research firms. And the reason I say that is both of them are research-only companies. They don't have an investment banking division, right? Goldman Sachs and Morgan Stanley, they're fine companies as well, and they provide great research, but they also have an investment banking side of the business where sometimes you wonder if there's conflicts of interest that are taking place behind the scenes. After all, if Morgan Stanley wants to earn like the next great secondary offering from the company or the next big bond offering for the company, they might hesitate saying that this is the worst company on the planet, right? Because they want to kind of benefit the other part of their business. There's supposed to be, a Chinese wall between those two areas, but it still makes you wonder in the end. So anyway, I like Value Line and Morningstar for a couple of reasons. First of all, it's free for many of us through our library systems. And then secondly, they don't have conflicts of interest because they don't have investment banking division. So with that out of the way, let's go ahead and kind of unveil our choices here today, and then we'll get into the Morningstar analysis. So the two companies we're going to look at are in the industrials space. And so as you can see here, and so Dwayne, I had already put that up, but and asked you if you wanted to take a screenshot of it, that you could. So I don't know if you missed that or not, but there it is again. But if you could quickly do that, that would be wonderful, because I gotta get moseying along here. And if you remember, if you miss it, if there's ever a time where I have it set up there, and I think I had it sitting there for a couple of minutes here today, which is longer than I normally do. But if there's ever a time where you're like, well, I can't get my screenshot, technology out or whatever, remember, you can always watch the recording. So anything you see here during the live class is also available for the recording there. Let me know when you're done there with that, Dwayne, so we can mosey along, though. And if you're writing these down, then I'm just going to have to move on. You don't want to disrupt the whole class, right? There's 85 people in here, so we don't want to halt and pause the whole class on the account of one person. So I would highly encourage a screenshot technology rather than just writing down with a pen and pencil. Obviously, that's going to take a little bit of time when we're dealing with dozens of companies here. Dwayne, are you still with us there? I'm still waiting for you to let us know when we can move on here. Maybe I should start playing that Jeopardy music for Dwayne. I'm going to assume that Dwayne has logged off here since he's not responding to me. So let's just go ahead and move on with our class here today. Let's go ahead and take a look here at CHRW versus Snap-on. As you can see, both of these are industrials companies. That's another thing I should mention about the differences between the Monday afternoon class and this Tuesday morning class. In this Tuesday morning class, I try to make sure that the two competitors that we have to one another are both in the same sector, so that way it's closer to an apples to apples comparison as opposed to apples to oranges. In my Monday class, I don't have that luxury. Remember, we're looking for a very specific setup in my Monday class where a stock is just barely over its blue line on the dividend stair-step chart. In this class, we have much more flexibility there because we can look for a stock that is trading anywhere below its blue line. It might be only a 1% below its blue line. It might be 10% below its blue line, but it does give you more choices. So that's why I have the ability to do that here versus not really have the ability to do that in my Monday class. Now, we don't score this out by market cap, but as you can see here, these are very similar types of companies. This is, in the case of C.H. Robinson, this is a company that's just barely above what I would consider to be a large cap company. In my own mind, I think of $10 billion plus as large cap, and anything below that, in this case, an $8.8 billion company, as being a mid-cap company until you get down to the $2 billion level, which I would then say is small cap if you're below that. So I would call Snap-on a high-end mid-cap company, and I would call C.H. Robinson a low-end large-cap company. But as you can see, they are both very similar to one another, and both of those are very easily digestible market caps for somebody else that might want to buy them out, right? We've been talking, of course, about TD Ameritrade here recently. That was a $26 billion deal, just to kind of put that into context there. Both of these companies are less than half of that deal's value. So depending on who's shopping the various businesses out there, both of these could eventually become buyout targets. Let's start the process now of scoring this out. And I should also mention that for those of you that are new to dividend growth investing, let me get you this link right here. This is where you can get this screenshot, and I'm just posting this into the chat for those of you that are here live. But this particular website is maintained currently by Justin Law. It used to be Dave Fish that put the spreadsheet together originally, and it's something I've used for a decade myself. Unfortunately, Dave Fish passed away about a year and a half ago, and so Justin Law kind of picked up the torch and ran with it, which we are all appreciative of. But this is a free resource. Now, the downside of it is it does only get updated once per month. And as you can see, it was just updated here yesterday. So I do have the most recent version of it, but you would just simply click on where it says Excel spreadsheet here. So I would encourage you to bookmark this website if you're a dividend growth investor and perhaps come back to it on a monthly basis whenever they update the numbers. It's a really, really great resource. Let's start scoring this out now. As you can see, we do have C.H. Robinson as the best of these two in terms of the number of years of increases. They have 21 years in a row of dividend increases. SNA, which is Snap-on, only has 10. And so with C.H. Robinson Worldwide, this company can make the claim that they raised the dividends in both the dot-com bubble and also during the 2008-2009 financial crisis, right? And that's something that Snap-on cannot make the claim of. Both of their dividend yields are very similar to one another. Now remember, when the stock market is close to all-time highs, like we are at right now, our choices start evaporating in this class, and we don't always get the highest yields, which is not something that we are necessarily set forth to accomplish, right? We don't look for companies that have, let's say, 10% yields. That would be obnoxiously high and likely ripe for a dividend cut. So we tend to look for those that are kind of closer to, let's say, like a 3% yield. But our official rules, and by the way, for those of you that are premium members, you can go to the resources area of our blog to find my trading plans for my various classes. And in that trading plan, it will suggest looking for a stock that has a yield higher than the S&P 500 and higher than a 10-year Treasury yield. And in this case, a 2.6 or a 2.69 are both higher than both of those particular areas. So we will go ahead and award this to SNA in this particular case, but you can see that both of these yields are very, very close. Now, in the case of this spreadsheet only getting updated once per month, one thing I will remind those of you that are new about is that if you're getting closer to the end of the month, remember the yields will change as the month goes on. And so there will be times where you need to kind of update the yields on your own. But in this case, this is very fresh information. So I'm confident to say that SNA is slightly higher yield. In the case of the most recent increase, you can see right here that we have 13% most recent increase on SNA. And you can see right there that 8% is for CHRW. Now, I would consider 8% increase to be acceptable for a current holding of mine. But if you can get those that are in the teens and sometimes even 20s, right? We've seen like stocks like Starbucks and Boeing in the past, Home Depot with more than a 20% increase. It's pretty rare, but it can happen even on the highest quality companies. More often we'll see those that can kind of consistently do it in the teens. And so Snap-on is one of those rare companies that's not only done it here in the teens most recently, but as you can see, they would win both of those scores on the 5-year and the 10-year annualized numbers as well. So this is a company that is consistently, year in and year out for at least a decade, raising that dividend on average over 10%, which is really quite exceptional. You can see from a payout ratio perspective, Snap-on would also win that horse race. Both of these are quite good from that perspective as well. For those of you that are not familiar with an earnings per share payout ratio, think of it in terms of lower is better. So kind of like golf scores, right? Lower number is better. The closer that number would be to 100% would be the closer to that company being really constrained in order to raise that dividend in the future. With both of these companies at 30 or 40%, they have plenty of headroom between where they're at currently and 100%. And even if their earnings per share did not increase next year, I would anticipate both of these companies would likely still raise their dividends. In terms of the PE ratio, you can see that Snap-on would be considered cheaper in terms of a PE ratio versus CHRW, but I would say both of these companies are good on that metric there as well. So far, I kind of like what I see out of both of these companies, even though I don't know if we've ever talked about these companies in depth, at least recently we haven't. So kind of interesting. Both of these have really very good fundamental metrics here that I've seen so far. As you can see, the ROE is a little bit of a different story. We're going to award that one to CHRW, where you do have a higher return on equity. There you want higher numbers. It gives you a sense of how proficient the management teams are at both of the companies in kind of funneling investor dollars into the highest profitability types of projects that are available to them. One of the ways that can be skewed is through debt to equity, and so be aware that CHRW does have a bit more debt, so it's possible that that is influencing that ROE number, but we can see that both of these companies are actually pretty decent when it comes to their debt to equity ratios. On this particular number on this spreadsheet, we oftentimes are looking for 1.0 or less. In fact, right down below here, you can see that there are 850 companies in the United States that have at least a 5-year history of dividend increases. The average company on the spreadsheet has a debt to equity ratio of 1.2. Both of these are dramatically less than that. And that's a great thing. You guys have heard me talk about industrials in the past as being one of the most cyclical sectors out there. That can be a dangerous thing for long-term investors, because the more cyclical your business model, the greater likelihood is that it's feast or famine in terms of profits. And if the famine is too bad in the off years, you might have a greater propensity for that company to cut its dividend. So you want these companies in the good times like we're in right now to have a very low debt profile. And I would say both of these companies have done a good job on that front. In terms of the beta, you can see we would award that to C.H. Robinson worldwide. It has a beta of less than 1. Now remember, that is a defining characteristic of a lot of high-quality dividend growth companies. Again, look down here to kind of get a sense of averages. The typical beta of the 850 companies that have at least 5 years of increases is only 0.89. And remember, a number below 1.0 basically means that that company moves around with less volatility than the S&P 500. So by its very definition, you do find that dividend stocks are considered mature, low volatility types of companies. So in this case, you'll notice that C.H. Robinson has a beta less than the average for all 850, whereas SNA would be considered a bit more volatile at 1.23. Now, that doesn't mean that that company can't do well over the long term. It just means that if you have a portfolio filled with betas of more than 1, you might have a rockier experience. You might have more exaggerated ups and downs on your brokerage statements as time goes on. I wouldn't consider 1.2 to be dramatic or anything like that, but just pointing it out there for those of you that want to have like the most kind of sleep well at night experience. If that is kind of your driving factor in how you select stocks, then perhaps you will want to look for low beta types of stocks. All right, so as we score this out, you can see there were 3 scores that were earned by C.H. Robinson, and then there were 7 scores earned by SNA. So right now, SNA has an early lead, but we're not done yet. We want to learn more about what are the company's prospects, what are their economic moats, et cetera, et cetera. And so for that, we are going to move on over here to Morningstar. I've got a few things highlighted here that I want to review with you guys in class. So first off, let's talk about C.H. Robinson, then we'll get into SNA. So C.H. Robinson is a 3-star selection. You can see that it's a wide economic moat. On to the analyst comments more recently here, and this was updated basically on Halloween by Matthew Young, the analyst over at Morningstar. So he says, C.H. Robinson dominates the $75 billion U.S. highway brokerage market, and we think its immense network of shippers and asset-based truckers supports a wide economic moat. Although the company isn't immune to cyclical downturns, its variable cost model helps shield profitability during periods of lackluster freight demand, as evidenced by a long history of above-average operating profitability. The firm does not own transportation equipment, and more than 70% of operating expenses are tied to performance-based variable compensation, which tends to move in line with net revenue growth over the long run. We think that the firm remains well positioned to capitalize on domestic third-party logistics consolidation, including market share gains despite intensifying competition. Over and above underlying shipment demand trends, market share gains will probably remain the key growth driver for Robinson. For perspective, we estimate Robinson's stake of the domestic freight brokerage industry approximated 20% in 2017, up from 13% in 2004, based on market data from Armstrong and Associates. The truck brokerage business is still vastly fragmented, and smaller, less sophisticated providers are finding it increasingly difficult to keep up with rising demand for efficient truckload capacity access and informational know-how. Robinson's industry-leading network of asset-based truckload carriers, most small, will likely remain valuable to shippers in the years ahead. This is particularly because truckload capacity will see growth constraints over the medium term due to constrained driver pool. Robinson also has positioned its international air and ocean forwarding operations to contribute to growth. In the segment, it competes with other top-shelf providers like Expeditors International. In late 2012, it purchased Phoenix International, which has more than doubled Robinson's scale in this business. More recently, the firm acquired Australian global forwarder APC Logistics and Canadian forwarder Milgram. Buying scale is important in order to secure adequate capacity for shippers, particularly during the peak season, which of course we are in right now with all of you buying your Black Friday and Cyber Monday sales. I know I'm going to be getting a lot of boxes coming to my house here in the next couple of days, so perhaps some of them will be shipped partially by C.H. Robinson. Let's go ahead and talk about the economic moat now. C.H. Robinson maintains a wide economic moat thanks to the network effect. Its industry-leading network of shippers and carriers reinforces a compelling value proposition, and duplication by small providers with fewer resources would remain a formidable task. In its core North American surface transportation segment, which is 64% of its net revenue, which largely reflects highway brokerage operations, C.H. Robinson's customer base of more than 40,000 shippers affords significant buying power. As a result, the company can procure capacity at lower rates than shippers could generally obtain directly with carriers, thereby providing customers with opportunities for material cost savings. So this is a company that they're going to use to save money themselves. Shippers also enjoy the added benefit of converting fixed transportation costs into variable costs when outsourcing logistics management functions. Furthermore, C.H. Robinson's vast network of more than 60,000 asset-based carriers across most transportation modes acts as a valuable source of capacity for shippers. As in the past tightening cycles, the company's unmatched truckload capacity access has proved quite valuable over the past year, given unusually tight capacity rooted in widespread ELD adoption. Furthermore, the constrained driver pool has prevented most truckers from offsetting lost miles with fleet growth. Additionally, C.H. Robinson's relationships with air, ocean, and rail carriers support multimodal capabilities that optimize shippers' use of truckload, less than truckload, and rail intermodal on the domestic front and air and ocean freight for overseas shipping. We believe demand for multimodal solutions is rising, driven in part by improving service levels from the rails and shippers' focus on supply chain efficiency. This dynamic should play well into the hands of 3PL providers such as Robinson, because asset-backed truckers must focus on maximizing tractor utilization. From the perspective of carriers, C.H. Robinson is a highly attractive source of freight opportunities given its ability to aggregate fragmented demand across broad customer base of shippers. In this way, truckers can minimize empty miles and supplement sales efforts. While competitors with sufficient capital can replicate technology, C.H. Robinson's robust proprietary IT platforms provide differentiation from smaller providers with fewer resources. We expect the company to garner additional market share from less capable 3PL competitors as supply chains continue to increase in complexity, requiring sophisticated informational expertise and broad vetted capacity relationships. C.H. Robinson's strong technology infrastructure, coupled with a vast reservoir of market data, also enhances internal pricing decisions and improves customer connectivity and reporting. From a bulls say versus bears say perspective, let's start with the bullish side of the argument and then talk about the bearish. C.H. Robinson enjoys a long history of impressive execution throughout the freight cycle, and the firm has thwarted a host of competitive threats over the years. We believe C.H. Robinson has gradually increased its share of the truck brokerage industry to represent 20% compared with 13% in 2004. Robinson's non-asset-based operating model has generated average returns on capital near 30% during the past decade, well above average returns generated by most traditional asset-intensive carriers. Now on to the bearish argument. A fragmented marketplace and the potential for high capital returns are attracting competition to the truck brokerage space, including startups, brokerage operations of asset-based carriers, and more recently, digital freight matching entities. So remember that with companies like Uber Freight, there are disruptive forces even in an old line business like trucking. It says small brokerage operations, once limited in scope, are becoming more efficient and more of a competitive threat as they are acquired by larger, more capable 3PLs. C.H. Robinson's mid-cycle gross profit margins on truck brokerage business will likely shake out below the firm's historical average. All right, so now that we have a better feel for this company called C.H. Robinson, let's now compare it to a different company in the industrial sector. This is Snap-on Tools, probably one that many of you are familiar with if you're a kind of a hobbyist or a do-it-yourself type of a person, or even a professional in the construction business. You're probably familiar with Snap-on. So Snap-on is currently rated 2 stars, and it currently has a narrow economic moat. Let's see what Scott Pope says about this company most recently of October 27th, or actually October 17th. It says, despite a favorable reception to Snap-on's latest products, organic revenue increased by only 1.4% year over year, excluding currency effects. Lackluster European and Asian markets continue to impede revenue growth, which can partially be explained by Brexit and trade uncertainty. Overall, the expansion of Snap-on's sales model outside the U.S. appears to be, I don't know what that is, to be honest with you. Some of you might know of it. Sisyphean task. The contribution of non-U.S. revenue has declined from about 38% in 2012 to 30% year to date. Snap-on's profitability was solid in the quarter due to strong financial services performance combined with corporate expense management. This allowed earnings per share to grow 4% year over year to $2.96, which beat consensus by 3 cents. Somewhat surprisingly, gross margin dropped across manufacturing segments, including tools, which has modest exposure to foreign markets. After its mixed quarterly performance, Morningstar's outlook for Snap-on remains unchanged, and they are maintaining their fair value estimate at 142. A favorable combination of increasing vehicle complexity and low unemployment continues to drive adoption of Snap-on's latest tools, such as its CT9075 impact wrench. Boy, that sounds like a really important one, which has been an enormous hit with automotive technicians. Similarly, the ever-increasing need for improved labor productivity in critical industries, including aerospace, energy, and defense, is driving adoption of its latest torque products that came with Snap-on's 2018 acquisition of FastTorque. Customers have demonstrated a strong appetite for these tools, which enable faster jobs and prevent worker injuries. Snap-on continues to expand its capabilities through acquisitions, which we believe will increase customer stickiness in the long run. This past quarter, it purchased Cognitran for $31 million. The software as a service firm provides multilingual content management solutions along with digital service record tools to OEMs and their customers. We believe similar acquisitions are likely in the future and will benefit investors. Let's now talk about their economic moat. Snap-on's competitive advantage and narrow economic moat rating are derived from its strong brand and its continual innovation. The company has the highest reputation for quality and strong service-oriented dealer network. Snap-on's fleet of tool-stocked vans is larger than the combined total of its two closest competitors, which would be Stanley Works Mac Tools and Danaher's Matco. And I've even seen a few of those Snap-on trucks driving around my neighborhood as well, so I know they're out there, which allows franchise dealers to focus on smaller sales territories. The company's reputation as a provider of premium hand tools among vehicle repair technicians enables it to garner higher margins on its products. Maintaining its premium status requires the company to constantly produce quality products that increase productivity within vehicle repair shops, a growing task as vehicles become more complex. Snap-on's healthy returns on invested capital underscore the benefit of its premium brand. Since 2008, the return on invested capital, including goodwill, has averaged 16.5%, producing economic profit of more than 7 percentage points above the firm's 8.9% estimated weighted average cost of capital. Let's now talk about the bulls versus the bears, starting with the bulls. It says that competitors Matco and Mac Tools manufacture less than 50% of the tools they sell, limiting quality control compared with Snap-on, which produces 70% of the tools sold by its franchise dealers. So they have more control over their product mix. It goes on to say that Snap-on has several growth runways outside its traditional market, including aerospace, industrial, and oil and gas. The company's high-margin diagnostics and information business continues to benefit from a transition toward increased vehicle computing power. Now from the bearish side of the argument, it says the captive finance company could take on excessive subprime credit risk to bolster hand tools sales. However, we have seen no evidence that credit policy has been too loose. Rising steel prices can threaten Snap-on's profitability in the near term, while earnings at its franchisees could suffer from increased in fuel costs. And then lastly, the company's U.S. dealer count fell precipitously in the middle of the last decade. Although it appears to have stabilized, the inability to expand the network diligently over the long run could weigh on the top line growth and jeopardize Snap-on's market share. Okay, so now that we've gotten a chance to learn a little bit more about these two companies from both a fundamental metrics perspective and now a business analysis perspective, let's take our conversation back on over to the Paper Money platform. And I want to show you our charts. So the chart on the left is CHRW. The chart on the right is Snap-on Tools. With the stock market getting clobbered today, both of these stocks are down, presenting a better opportunity to buy them today than they were yesterday. That's always a nice thing. In the case of CHRW, it's down 2.7%. In the case of Snap-on, it's 1.1%. But what brings these two companies together, and the reason that we're talking about them today, is you'll notice both of their prices are below this dividend stair-step line in blue here. For those of you that are newer to this class, the dividend stair-step line represents an area where investors have historically been willing to buy these companies for their income potential. In the case of CHRW, you can see that its average high yield over the last 10 years has been 2.53%. It's at that level where investors have found value. You can see that even on this chart. Over here, if you had bought it, you'd have been happy about that. If you'd have bought it right here, you'd have been happy about that. If you'd have bought it right here, you'd have been happy about that. So that's kind of the general idea. We look for above average yields on the companies specifically to their own dividend history. So while some of you might not think of 2.64% as a high yield, it is considered high comparing itself to CHRW's history with its own dividend yields. Same thing can be said with Snap-on Tools. You can see that historically it has been viewed as an attractive investment when it's yielding 2.66%, which is where the stock is priced at this kind of horizontal blue line on the chart right here. Currently, its yield is 2.77%. And therefore, it would be viewed as attractive. And you can see that the last time it traded below the blue line back here late last year, that would have been an attractive time to be picking up this particular company. Okay, so that's kind of the general idea there. I can explain that more in further classes for those of you that are unfamiliar with looking at these charts. But the main thing you can think of is if the stock is below the blue line in this class, we consider that to be attractive to consider for the long term. So now what's going to happen now that we're at the top of the hour is we're going to vote. You guys are going to go to bat and bring your collective intelligence together and determine which of these two, if any, deserves a slot in our portfolio. Now remember, if you don't like either of these two choices, it's perfectly fine to vote for none of the above. So let me open that poll. If you're new and you're not seeing the poll populate automatically, look for those little WebEx floating icons at the bottom of your screen and look for the one that looks like a bar graph. Once you click on it, you should see the poll. Once you've made your selection by clicking on it, you then have to hit submit, otherwise the system does not tally up your vote in the end. I do appreciate as much participation as possible just to get you in good habits in this class, even if you're brand new. I'll start playing that Jeopardy music to let you know to get your vote wrapped up. Best of luck with your decision. All right, let's see what's on your guys' minds today. You guys did a great job with participation, by the way. Kudos to you for that. I really appreciate you guys' enthusiasm in these classes and your willingness to participate. As you can see, those of you that are in class right now, Snap-on was the winner by quite a wide margin. 45 of you went with Snap-on. 24 of you went with CHRW. And 8 of you said, nah, don't really like either of these two choices, and then 7 of you did not answer. So we will be going with Snap-on Tools here today as our most recent selection for our long-term portfolio. So let's come on over here to the Trade tab. Let's go to Snap-on Tools. SNA is the ticker symbol. Let's go ahead and get our calculator out, and let's take, actually we just need $10,000. Of capital, since that was our starting 4% of our portfolio. So $10,000 divided by the current price of Snap-on is $156.04. That means we can buy 64 shares. So I'm going to just simply click on the ask price. I'm going to change my 100 in the quantity down below to 64. I'm going to come over here from where it says limit, change that to market. I'm going to leave that as day right there. I'm going to click on confirm and send. Make sure I'm spending about 10 grand, and I am, so I can go ahead and send this off. And I was just filled at 156.05. Thank you very much for joining us here. I will put that trade information in our class forum and also send it out by Telegram as well. David should be kicking off his class week here later on today. I'm sure he would appreciate you joining his class as well. So make sure you're checking that out. And then later on today, I'll be doing the Market Outlook video. And of course, tomorrow, I'll be getting back in the swing of things with my factor-based swing trading class. So hopefully I see you in one of those presentations along the way. If not, I want to wish you all the best of success with your trades and your investments. Goodbye for now.